Hi, and welcome back to the Food Fund, where we analyze investing in food stocks, beverage stocks, and restaurant stocks. If you are new here, our goal is to help you put your money where your mouth is and invest in the best food companies. Is the United States' largest meat company a good investment? In this video we will be analyzing if Tyson Foods stock is a buy. Could Tyson Foods, stock ticker symbol TSN, be due for a rebound? Let's find out. We have a lot to cover, so let's go ahead and jump right in. Cue the logo. Let's start with some background info on Tyson Foods. Tyson Foods was founded in 1935 by John W. Tyson as a multi-protein powerhouse. Originally focused on poultry, the company diversified in the 1980s with beef processor acquisitions, making them a major player across the protein spectrum. Today the company processes and sells chicken, beef, and pork. They're not just about raw meat though. They also own a well-known portfolio of brands including Hillshire Farm, Ballpark, Wright, Adels, and State Fair. Headquartered in Springdale, Arkansas, Tyson Foods employs a whopping 141,000 people and has a strong presence in the Midwest and South. Now let's look at the price action. Starting with the 1-year chart, we see that Tyson Foods had a CAGR of about 1%. Zooming out to the 5-year chart, we see that Tyson Foods had a CAGR of -4%. Tyson Foods' share price has had a small upwards trend recently against a backdrop of declines. If we perform a backtest comparison of investing $10,000 in Tyson Foods versus the S&P 500, we find some interesting results for Tyson Foods. In that comparison with the S&P 500, $10,000 invested in Tyson Foods would have grown to $13,049 or a 5% CAGR versus $21,877 or a 16% CAGR if invested in the S&P 500. This demonstrates underperformance for Tyson Foods. A Tyson Foods investment would have also been more volatile with a 27% standard deviation versus 18% for the S&P 500. Tyson Foods outperformed the S&P 500 in terms of the best year performance, for which Tyson Foods grew 74% versus S&P 500 31%, but had a worst year performance where Tyson Foods fell 27% versus the S&P 500 18% fall. In terms of max drawdown, Tyson Foods fell 48%, more than the max drawdown of 24% for the S&P 500. Tyson Foods did underperform the S&P 500 in comparisons using the Sharpe ratio and the Sortino ratio due to its excess volatility. Now let's hop over to market share and take a look at Tyson Foods' market share. Here we have the dashboard, where we can quickly gather a lot of information at a glance. Expanding the dashboard, we can look under food and see that Tyson Foods is categorized under farm products. Expanding the farm products tab, we can see that Tyson Foods has the third largest market share but is very clearly not growing. Let's look closer at the year-by-year changes in market share. So we come down here and type in the ticker symbol for Tyson Foods and see that the market share is 5.56% out of the publicly traded food, beverage, and restaurant stocks currently in the market. Tyson Foods attracts a pretty significant portion of food spend. However, the market share is not growing. The 5-year market share CAGR for Tyson Foods is -1.84%. This means that Tyson Foods' market share has been declining over time despite its market dominance. If we start in 2019, we see that the market share was 5.99%, 6.03% in 2020, 5.63% in 2021, 5.78% in 2022, and 5.56% over the trailing 12 months. Consumers are choosing to spend money elsewhere. In this version of market share, we can also compare Tyson Foods with other companies or entire industries. When we type in BG, the ticker symbol for Bunge Global, an agribusiness producing about a quarter of Tyson Foods' meat output, we can compare the market share data for those two companies. Tyson Foods holds a 47% share of the combined revenue between the two companies. Sadly, Tyson Foods has been losing market share to Bunge on the order of about 2% per year. This is not good for Tyson Foods. Let's take a look at the fundamentals to learn more. Gross margin is 5%. This is on par with expectations. Revenue has compounded at around 5% over the past 5 years and has reached over $52.9 billion most recently. Meaty. Looking at cash flow, we see a -2% CAGR over the last 5 years for operating cash flow, while capex has worsened at a 7% CAGR. As a result, free cash flow has fallen at a 16% CAGR. This is not good. Falling operating cash flow is worsened by rising capex. When looked at in combination with the falling market share, this could spell trouble for Tyson Foods. Weighted average shares outstanding have fallen over the last 5 years, going from 366 million shares in 2019 to 354 million shares most recently. Tyson Foods has been buying back shares. I personally think share buybacks are one of the most efficient uses of capital, and the company has clearly been committed to doing so. Now let's view return on invested capital. Return on invested capital has fallen from 8.5% in 2019 to 1.9% in 2023. This is horrible. Tyson Foods has become less efficient in driving profits from its investments. Again, the red flags for this company are adding up. Another favorite metric is cash conversion cycle, a measure of operational efficiency regarding supplier and payer leverage as well as inventory control. Going from 36 days in 2019 to 36 days most recently, Tyson Foods has neither improved nor worsened their operational efficiency. The trend for cash conversion cycle seems to bottom at this level, so we could expect a worsening of this value in the near future. Now, let's look at Tyson Foods' debt. The net debt to EBITDA has increased over the past 5 years, going from 2.9 in 2019 to 3.9 most recently. While this debt level is not high, the metric is trending in the wrong direction. Last, let's explore dividends. Current dividend yield is 3.2% with a dividend payout ratio of -80%. A negative dividend payout ratio means that net income is negative or is expected to be negative, and in either case is a very bad sign for the company. Tyson Foods is paying out dividends that its earnings cannot support. This indicates that the company's dividend practice may not be sustainable. Dividends per share for this company have grown at an 8.6% dividend per share CAGR over the past 5 years and a 24% dividend per share CAGR over the past 10 years. The rate of dividend growth has slowed tremendously over time, and with the negative payout ratio we can expect dividend growth to continue to slow. The fundamentals of Tyson Foods are not good. In any event, should it be added to the portfolio? Before sharing my final thoughts on that, please click the like button and let YouTube know that you like the content. Subscribe and click the notification bell to make sure you catch the latest videos. Your continued support means so much to the Food Fund. Now, let's get into my final thoughts. Okay, let's go to the spreadsheet and write out some key values for Tyson Foods. It is a food company with a gross margin of 5%. The 5-year revenue per share CAGR is 6% and the 5-year free cash flow per share CAGR is -16%. The share buybacks are really helping the revenue per share growth. Despite this, free cash flow per share growth is still really bad. A return on invested capital of 2% is also really bad. Next, the cash conversion cycle of 36 days is high, and I think it will only get worse. Concerning debt, a net debt to EBITDA of 3.9 means that it would take Tyson Foods nearly 4 years of earnings to pay back their debt. So from a fundamental standpoint, Tyson Foods looks bad. Now let's switch our attention over to valuation. Tyson Foods is poorly valued relative to the S&P 500 with a ratio of -0.9. The price to earnings growth, or PEG ratio, could not be calculated due to the negative projected earnings growth. Tyson Foods is not a good company. From the falling market share to the declining free cash flow, this company has many challenges. While share buybacks and dividend raises may help slow the decline of fundamentals on a per share basis for some investors, the trend towards badness is undeniable. Unfortunately, many of their challenges are inherent to the meat packing industry. For instance, the gross margin of 5% means that the cost of producing the meat is very expensive, and the company has not been able to pass that expense on to customers. Another challenge can be seen with the cash conversion cycle. Days inventory outstanding have been increasing over time, meaning that the company has to store more and more meat in refrigerated storage, which is not cheap. And remember, meat has a finite shelf life. If it is too old, it has to be thrown away, which is a huge hit to the company's bottom line. For these reasons, I am not particularly interested in meat packer companies. However, this company has been in existence since before World War II, so I don't think it will go out of business. It is just much too difficult to invest in, especially when there are more fundamentally sound, faster growing companies available. For me, Tyson Foods is not going on the watch list. Many thanks for watching. What do you think about Tyson Foods and meat packer companies? Please share your thoughts below. It is always great to hear from you. Please check out some more videos right now and don't forget to put your money where your mouth is.